So as a financial advisor, one of the coolest things we get to do with clients is help them take the low-hanging fruit, easy, guaranteed returns. And here's a great example of that. This client recently had a pay rise, got him to about $150,000 a year. He also had recently sold an investment property, so had a couple $100,000 to invest and came to speak to us. And had a few debts to pay off and was thinking of putting it into an ETF or something like that. Had some really great ideas, but one thing that we were quick to do was to say, hey, let's jump online. You can go to MyGov and actually check this and see exactly what unused concessional contribution cap you have from the last 5 years. Because a little known fact that you can actually go back up to 5 years, so in this case back up to 2021 financial year, and check the caps that you didn't use. So this client hadn't made any voluntary contributions, so just the employer contributions, but they'd gone back. We were able to go back, and I've summarised it in a spreadsheet here to show you his income had steadily increased since then by the usual 3% of the employment contract. So from 2021 to 132,000 up to what's now about 150. The super guarantee contribution rates had also gradually gone up as a percentage from 10% to 12%. And so here, the actual contributions here that the employer put in, and the contributions caps for the years, they've also gone up gradually. So from 25,000 up to 30,000. So we're able to do the numbers there and calculate the unused caps down here. And so over the last 5 years, a total of $53,000 unused. So that's the amount you can actually then throw into superannuation this financial year. So basically, if had just said, oh, look, I've earned $150,000 this year, to his accountant, likely to pay just under $40,000 in tax. But if you throw that in, the $53,000, that reduces your taxable income to $96,000 there, just over. And therefore reducing your tax quite significantly down to $21,000 for a total income tax saving of about $18,000. So when we look at that further, we have to account for, though, obviously, that there is some contributions tax when it goes into the super fund there. So about $8,000, so that's 15% of the amount you put in. So you take that off, but still $10,000 ahead in tax save. So that's a guaranteed return. Money back in your pocket, low-hanging fruit, equivalent to a guaranteed 19% return on that money. That's before it's even invested. That's before it's even making any returns. On top of that, goes into super. The money goes into super and earns returns at a lower tax rate. So rather than paying his 37% marginal tax rate that he would pay on the returns if it was in his own name, and above that, he's paying 15% ongoing. So that's a side benefit. But here we can see here, effectively, because he saved